Hello and welcome back to Dukascopy TV. I'm Monica Gibson and I'm joined down the line by Michael van Dulken for our weekly wrap-up programme. Michael, could you please start by outlining what you think have been some of the biggest market movers this week? Were there any surprises, would you say?
Yeah, I mean, obviously the UK holidays made the start of the week a little bit quieter. Kicked off with some I guess the surprise rate cut by the World Bank of Australia, which came in a bit earlier than expected. Then we had some in Europe, some good data from Germany, two lots of data in a row actually, factory orders and industrial production, which pleased the markets and led to a bit more optimism towards the Eurozone. China's trade balance stronger than expected, appeasing some of the worries about growth from the region. And then we had the UK coming in again with its own stronger industrial production. No move by the Bank of England, and US jobless claims coming supporting more speculation of some tapering of QE3.
ECB cut rates and say they are ready to act again, but some analysts say negative interest rates could actually worsen the problem. They will not boost lending if there is weak demand for loans, and our banks are prepared to pay for safe deposits with the ECB rather than make loans that they will fear will not be repaid. But what do you think?
I mean, for now it's purely an idea. I mean, don't forget how quickly, I can't remember who it was now, there might be those moves and backtracked on that, saying, this is just something which is considered. Don't forget these meetings, they have to consider almost everything. However, they can use that as a tool post these meetings to say, well, we have looked at this. This tends to generate a lot of interest, but don't forget the Bank of England has mentioned this too, and any discussion surrounding that I see still designed more as a stick rather than anything to actually be used. And we have seen that negative rates used by some actual banks rather than central banks, but no central banks as yet. As far as the rate cuts concerned last week, I still don't see it really helping the core problems. It's boosted equities, no doubt there. I mean, we're trading new highs on the DAX. FTSE's playing catch up. The US is still doing very well, but will it get to the root of the problem in helping with credit flow, either from a broken transmission mechanism or in boosting confidence? Will it boost growth in areas of Europe where it's most needed? I agree that negative rates is a big risk, and if it did come into effect, banks would have to decide whether it was worth paying for the privilege of a safe deposit. But don't forget, we already have negative German and ESM auction yields, so people are already paying for that luxury, and that does show that there still are weaknesses and fears over the region. Draghi said he's ready to act as before. That worked very well last year, and that led to the great rally we've seen since last July, and that seems to be enough now to be helping risk appetite. But more interesting, I think, was his potential talking of intervening in the asset-backed security market to try and unlock that broken transmission mechanism and get small and medium-sized lending really going, because that's where growth is really going to be born. And if anything, the euro, the weakness over the last maybe 24 hours in the euro is less on the prospect of another rate cut on its way. I still don't think that would help, and more on the back of the relative strength of the dollar. From a combination of the speculation of QE3 tapering, talk of China increasing its reserves, and the better jobs data I mentioned earlier.
New Zealand has resorted to market intervention when domestic conditions do not permit an outright policy rate cut, indicative of the global disinflationary environment at the moment. Do you think there is merit to this tactic? Given the Wheeler's in a bit of a tricky position. I mean, he outlined his criteria for intervening back in February and saying that he would do so when necessary. And he wasn't expected it, but obviously had to use that tactic. It's designed, I think he said, to take the tops out of any rallies, and rather than manage the currency, as we've seen, is being kind of frowned upon, unless you're Japan.
but more to slow its appreciation. So it is de facto tightening, and it's needed to counterbalance what is an overheating housing market with a strong Kiwi dollar, which itself is a product of a strong rebound in GDP, very benign inflation, and a stable base rate. So, and if anything, that's actually been keeping lending in check a little, maybe keeping the housing market from overheating way too much. But it is making life harder for exporters. So, he can't really risk making an interest rate cut because that has the potential to make the property market worse and indeed strengthen the currency even further. So, I think the merit is in the obligation of it being one of the only things left for him to use.
The RBA cut the benchmark rate 2 days ago, but since then, SocGen analysts have said it was rather trigger happy, especially in light of the blockbuster labour market data this morning. Was this the right move, in your opinion?
Well, it's very easy to say trigger happy when 2 days later you have a stellar jobs data come out. That's just kind of luck of the draw, I guess. Don't forget their meetings are all scheduled, as is the data. It's kind of swings and roundabouts whether you get in there early or late. But I mean, I guess you can agree. But from another sense, there had been talk of a rate cut for a while. Maybe it did come a little bit sooner than expected. But obviously that employment data was maybe the biggest surprise, because the significant rebound, and in one sense it may look to negate the need for a cut to some, but it will remain to be seen whether that employment data remains as strong in the months to come. However, it obviously has pushed back expectations of any further rate cuts much further than they had been.
The Aussie dollar had been quite expensive of late, but some analysts are saying that given Australia's robust domestic economy, the RBA is among the G10 central banks that are unlikely to enter the currency wars. What is your outlook for the Aussie dollar moving forward?
Looking at a graph here, you say it's expensive. Don't forget, it's broken down from what is a very significant sideways channel, 102 to 106, which had been in place really since August. I'm talking obviously versus the US dollar, and we're within a whisker of parity. So that's quite a significant comeback over since the beginning of April, or middle of April rather. So if anything, they won't need really to intervene if they're trying to do a Japan and make things easier for their exporters. It's so outlook there. I mean, it may find a bit of support around parity. I mean, looking back to prior lows of 2011-12, you're talking of 0.96. I mean, that's a fair way away, but it certainly has potential to go a bit further. And as I said earlier, the euro's weakening is more, I think, a function of the dollar strengthening over the last few days than anything. And I would see that as being the same case for the Aussie dollar, certainly since the last few days, with that fall below 1.02 and straight through 1.01. So I mean, its outlook, it's still doing okay. As you say, a robust domestic economy. Still some exposure to China, where there are those fears of is it growing as much, but it still seems to be ticking over quite nicely. Don't forget, one of those countries that did fairly well across the world financial crisis.
Well, that's all for our weekly wrap up. Click back to Dukascopy for a discussion on the latest data from China with my colleague Navjit Grewal. Bye for now.